Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now to the show at hand.
Matt Zalk here. I'm the host of the Same Day Podcast, where I connect with top business experts and real estate leaders. Past guests on our show include Lee Easton of AeroVision, Kurt Volk, an investor client of Keyrenters, talking about all sorts of fun stuff, including a 1031 exchange and doing the BRRRR, which is buy, renovate, rehab. Maybe that's the same thing, rent, and then refinance, I think. Something like that, BRRRR, or something like that. Mike Bosch of Atento Capital and Chip Gabarino, a local restaurateur and real estate entrepreneur. Today's episode is brought to you by Keyrenter Property Management. At Keyrenter Property Management, we are a full-service property management company helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of property management. Ross, you know this better than others because we're great friends and you've seen how we've grown the business over time, but you might not know about a little story with Ryan and Jason, who brought us a non-performing 14-unit property. And after we turned that unit, we helped them transition their portfolio from that one building into like 100+ unit portfolio, and we renovated a lot of their single family and multifamily properties over the past 4 or 5 years, and we're still working on a bunch of renovations for their single family portfolio. But that's a big part of what we do, and that's why no matter what rental you have, a single family home, a condo, a townhome, an apartment, we have the management solutions that you need. Go to keyrenterpmc.com or info@keyrenterpmc.com. Before we start with our introduction of Ross Heyman, I want to give a shout out to David Charney, a great mentor of mine and a colleague and mentor to Ross, or the Rossinator, as I lovingly call him. I'm grateful to David Charney for having introduced us both personally and professionally, both contexts. And we've done a lot of great fun stuff together over the past couple of years. We can get into some of that stuff. But by way of introduction, Ross Heyman is the chief of staff for Capital Homes, a production home building company, and Charney Properties, a real estate investment and development company in Tulsa, Oklahoma. He's currently focused on building a vertically integrated build-for-rent business that uses the company's expertise in land development and new home construction and property management to build excellent housing options for people in the Tulsa area. Ross is originally from Chicago, so you can hear it in his accent, but he calls Tulsa home for the past 14 years. Ross, welcome to the pod.
Thank you, man. Good to be here.
You and I have done a bunch of fun deals together, and we can talk about some of that stuff.
Yeah.
But I want to, before we get started with all that, tell us a little bit about how you got started, why you're in Tulsa, and how you got started in real estate.
Sounds good. Thanks, Matt. Originally from Chicago, I went to school in the Northwest at the University of Puget Sound. And as I was graduating college, was recruited for a program called Teach for America. And one of the places that Teach for America worked was in Tulsa, and hadn't heard much about it. I really knew very, very little about Tulsa, but had a job offer to come and teach third grade here. And that's what I did. So I taught for 2 years at McClure Elementary School. And that's how I got to Tulsa. So I was a public school teacher for 2 years, and then met my current boss and mentor and friend, David Charney. Met him through the community here in town. And he basically said, you'll have a phone, a desk, and a job for a year, and we'll figure the rest out. And that was about 11 years ago. So he took a shot on me, and I'm grateful. And we've done a lot of fun stuff since then. And it's been a really just a fun journey to trying to kind of help grow several different businesses that he's got. And this build for rent concept is something over the last really probably 3 or 4 years we've been pretty focused on and plan to continue doing over the next probably at least 5 to 10 years, I think. So
I love that story of phone, a desk, and a whatever for a year. But it reminds me of, now you and I are both involved in the resettlement effort for the Afghan refugees. There are 2 approaches, or there are multiple approaches globally for how to resettle people that have been displaced for whatever reason. The American approach is you've got we'll take a whole bunch of you. You've got 3 months of runway, and then you got to figure it out. Whereas the Australian approach is we'll take a very limited number. We're going to take 100 people, but we're going to give you runway for 3 years or 5 years and support you for potentially ever. But it reminded me of that because he's like, I'm going to take a risk I'm gonna give you, an opportunity, but I'm giving you a desk and a phone, and the rest is up to you, and make something happen. But that's, that's the traditional American way. Give somebody an opportunity and let them kind of make the most of it and see if it works for everybody. So
For sure.
you've been at Capital how long now?
Since 2011. So
Wow.
this will be my 12th year. Yeah.
Okay. And you've navigated the company. You've kind of worked in various things. You're now chief of staff. I want to ask you, before we get started in the various roles that you've played at Capital, what did you learn teaching at McClure that you were able to utilize in business?
Oh gosh, good question. I would say a pretty essential part of teaching, communication skills and teaching are critical, and being able to communicate ideas clearly. And then also the teaching world, we call it check for understanding. So making sure that someone understands the concept. To me, we have a small team. Most of the folks on our team have been with us for years, or they've joined recently and plan to be with us for years. So really working together, collaborating, communicating, being really a high performing, tight knit team is kind of mission critical for us. So I spend a lot of my day just communicating in different ways, whether that's verbally. I do a lot of writing for our company, communicating, kind of managing, building, developing relationships on behalf of the company, doing a lot of internal work. I would definitely say communicating is the number one. Organization too, but I've probably always been a little organized. So maybe even before teaching. Yeah.
Some soft skills. I love that. I mean, I came out of McKinsey and I've talked about it before on the pod, but I can't point to anything specific that I learned on the hard skill side. Like creating PowerPoint decks does not really, it's not really that useful, but certainly showing up on time, being professional, and communication, written communication is something that I learned, just like the general tools of being a professional. Before we dig into it deep, Lee, can you just explain to us the general, like the structure of the business, and because we're going to refer to various businesses, but I want everybody to be able to understand kind of the players that we're talking about before we dig in.
Yeah. So Capital Homes is our core business, production home building company. We build anywhere from about 180 to 240 or so homes per year. Charney Properties is our investment and development business. So we do other real estate investing outside of home building. We also do quite a bit of our own land development. So a lot of what Charney Properties does for and with Capital Homes is develop raw land into residential lots that are then built on. So our business model with Capital Homes is really building in neighborhoods. So we first develop a neighborhood, and the finished product for that is finished lots, and then we build homes, and that's really our core business. And then Tallgrass is a management company that I helped start probably about 7 years ago, that really exists for the sole purpose of managing our own real estate investments. So we don't do third-party work. We're not geared up with the systems and processes and technology of a group like Keyrenter that's grown with significance in the last several years. So we're really focused on high touch, kind of one-to-one property management on assets that we own that are kind of part of our portfolio. And that's probably right now around 250 or so units, with a pipeline of another 250 or so.
That's awesome. We'll get into some of the build to rent stuff. It's also worth noting that the risk profile of those businesses and the return profile of those businesses are very different. I mean, speculating or taking a raw piece of land with the understanding that your company, a neighbor, a sister company, or another company that does development will actually take those raw lots and eat them up in their production home building is the risk profile is very different. The return profile, I would expect, although I don't know in detail, it's different than taking it from a lot to a new home and selling that home. And that's very different. And the visibility into your potential earnings is very different than renovating a house, which is often what we do, and is what a lot of Charney Properties has done, because you can get a bundle of sticks and put them together and build a house, and almost to the penny what you're going to pay for stuff. But if you pull out a bit of sheetrock in an old house seeking to renovate it, and you find a massive flaw that you didn't know about ahead of time, your return profile can vary dramatically. And then, of course, on the property management business, property management is you guys don't do it as a strict profit center, as I understand, but it's a low asset, low inventory business, so it can be fairly profitable. Let's talk about Tallgrass Property Management for a second. You guys are a boutique company. We just, for the sake of transparency, you and I have done a lot of real estate deals together, and we have managed some of them in the past, and you are now managing a bunch of them. We can talk about a 1031 exchange, but you are managing, Tallgrass is now managing a bunch of those. You guys are an awesome boutique outfit. As you say, you're managing 250 with a plan to build another or bring in-house another 250 of those. What are some things at Tallgrass, the entity that you helped establish and build and grow and set process for, that you guys are super proud of, that you do really well?
Yeah, I mean, I think there's kind of two big facets to that. The first would be how we think about our business as it relates to our residents. So we're very, very high touch with our residents. We have a combination, I think, of kind of best in class technology coupled with a team that has been really trained and focuses on taking great care of folks. So pretty much from day one, when a tenant moves in with us, they kind of know this is a group that cares. They own this property. They treat it like they own it. They want to hear from us if something goes wrong. So being super attentive to different maintenance requests or things that come up, that's a really mission critical part. I think the best indicator to me of a job well done for us, it happens from time to time, and I'm sure Keyrenter has a similar situation, but sometimes we'll have a tenant that has rented a unit from Tallgrass, and maybe it's a 1-bedroom apartment, and they're getting married, or they're kind of moving on to the next stage in life, and they want a house, and they say, hey, can we instead of this apartment unit, we'd like to lease a home from you. And so I think that's kind of that's always sort of the best indicator of being kind of good to tenants. The other part is really how we run it more internally in terms of the financials and the accounting. And I'd say we really run each different property and then each group of properties held in an LLC as if they were their own business. So we have different lending arrangements, obviously, for each of our groups of properties. We do a lot of, I would say, maybe more particular accounting practices than the average group, because that's just kind of in our DNA. And so we have really good financials. We do accruals and prepaids and capture accumulated depreciation on our balance sheet. And so there's a lot of kind of more technical accounting related things that I think we do differently that allow us to monitor the performance closely and analyze what we should or shouldn't do with a given property.
It reminds me when you say tenant moving from one house to another. We've had Josh for 5 years. He's lived in 5 separate houses, and it's always been strategic moves based on jobs or childcare, a bunch of things. In our system, we can't have the same tenant at 2 separate properties, even over a different period, because of the way some of the things work together. So we add a little star. If it were Ross Heyman and Ross Heyman were moving, we'd add a star. So Ross Heyman's star would be the second tenant. And now we're up to 5 stars on Josh. And I was like, there has to be a better way to move Josh to different properties than to have 5 stars. So I thought maybe we should use an exclamation point or something. And then I was like, just add a 5th star, because I don't know what other systems I'm breaking if I don't do that. But for sure, it's a great compliment when somebody wants to stick with you. I also, it could also be because they don't want to pay another application fee, and you already know them.
That's true. That's true.
There's low friction if they just stay, which I love. I love that.
Yeah, for sure.
How do you think about banking relationships? You mentioned some of the debt that you put on the different property groups. Are you seeking lowest rate? Are you following other like loan parameters? Are you just loyal to one person and you do all of your banking there? Like, what are you looking for in a relationship with a banker?
That's a great question. Really, across our different businesses, I'd say we look for different things. No matter, in general, we're very big on relationships. So in terms of the work we do, whether it's a joint venture, closely held partnership, and super high levels of trust with our partners, the same goes for lenders. We've worked with the same lenders for years and years. I'd say in the last 2 years or so, we've kind of broadened our scope a bit because our company's grown. So for a land development project versus new home construction versus a rental property, for example. There might be different lenders that are more comfortable, fluent, geared up to offer better terms. And so we really try to, I would say we try to match our projects with the lender that feels the most comfortable with that sort of collateral, that sort of asset or credit. And then I think part of it is a little bit of the philosophy of our business. So in general, we tend to focus on growing a balance sheet and kind of assets under ownership more than, say, for example, yearly cash returns. So a lot of our lending is set up to pay down principal as aggressively as we can, which is maybe a reflection of kind of what we believe to be the most tremendous value within real estate, which is owning the underlying asset. The cash flow is great, but the cash flow from operations is kind of one of three ways. And maybe I'd say if I had to choose between cash flow, principal reduction, and price appreciation, we probably bet on principal reduction and appreciation the most and the least on cash flow in terms of the priority when we look at loan terms.
We've sometimes disagreed on paying down principal quickly.
It's I think probably like a lot of things. I mean, you've helped me learn this, Matt. I mean, truly, I can't tell you how many times I've talked with our team and said, well, Matt says this, and Keyrenter does it this way. And you can see our team saying, this again, but it's really, I do think the idea, let's say one of your clients or potential future customers had 5 or 10 different investments, having some that are really aggressive in the principal reduction and some that are really aggressive in cash flow. I think actually the answer probably would lie somewhere in the middle of having a little bit of, almost a blended or diversified portfolio in terms of how you're managing the risk exposure and the upside that comes from, paying the bank back as you need to.
Right. And so obviously on the one hand, if you pay down principal very quickly, then should the economy turn and the property be worth less than you had expected it to have been, you could theoretically sell it and pay back the bank. If the bank called the note, you'd have more options than if you were over levered and were paying back less quickly. You might be squeezed and have fewer options. But the benefit of having higher leverage and lower payback, which means a longer duration of payback, is that you have more cash available now. And if you're not,
right,
for example, going to Vegas and putting that money on black, but rather taking that cash and putting it into other investments, then you're able to accumulate real estate faster, theoretically. Of course, if you have a primary business that generates enough cash, then you might not have the need for that additional cash flow that the more aggressively levered asset or debt is, the levered asset is spitting off, and therefore you can pay down principal quicker. So it's a philosophical debate as to where you want to sit on that spectrum, but there's probably not a right or wrong answer. It's a right or wrong answer for a given scenario or a given person or a given portfolio.
Yeah, I think that's right on. And I also think we talk a lot about prioritizing the duration, like how long each of our loans are fixed for, right? So if you imagine, let's suppose someone was doing a significant amount of refinancing of a portfolio in 2021 or even early 22, maybe even early COVID. In that period, if you had done a bunch of really long amortization but short fixed period stuff, you'd be realizing a bunch of cash flow until about now, and then you've got to refinance in a tough environment. So I think one thing we think about is, are we reducing the principal enough within the period that is fixed that we feel like, kind of, not regardless of what happens, but in most scenarios that are likely to occur, we'll have made a good, healthy principal reduction. We'll have a better, more favorable loan to cost on our next cycle of that loan, or we might sell it. We don't often talk or think about selling things, but I suppose it's always an option.
Right. David Charney, your colleague and mentor, my mentor, has many wonderful positive attributes. One of those is that he comes from a legal background. He's an attorney. He has a deep understanding of real estate, and he thinks critically about things. And he's said many things that have stuck with me through the years. But certainly the way he thinks about banking relationships, he encouraged me early on to not just, I was banking with Security Bank and I love them and we still bank with them, but he encouraged me to have many banking relationships and to go deep with those, number, call it 3, 4, 5, whatever you feel comfortable with, so that when you need a loan, you're not going to them for the first time. Principally, you're not saying, walking in with a suit and a folio and saying, I need money right now, but rather you have an established track record of when you were able to shop and discuss and take time and build the relationship. And then he also taught me that, there are many people that shop for the lowest rate, that will squeeze and will try to nickel and dime their lenders so that they get the best rate. But the more valuable approach potentially in the longer term is giving a little bit on rate to a lender and taking, some origination fees down, or giving a little bit on rate and extending the duration, or just thinking about other terms of the loan that may be more important to you, but less important to the bank, or where you have a little bit of negotiating room, and not just being the person that goes around and is just looking for the cheapest loan at all times. So a lot of little nuggets from David, but those are two of them certainly.
Agree completely. I mean, I think he's certainly taught me a lot about how we think about that part of our business. And I mean, they're really, our lending relationships are the lifeblood of our business. It's our access to capital outside of our own. And I think I read a book one time. They talked about playing long-term games with long-term people. And that's kind of how we operate across the board, is we really, we have really high levels of trust with our lenders. They know that we'll be able to produce the reports they need and timeframes they need them, that we're always ahead of things, that we're taking good care of our properties, and that I hope that they would feel a high level of comfort and trust and confidence in us as a borrower. I mean, that's ultimately, right, I think, what in the world of real estate, to be a strong, creditworthy, trustworthy borrower. That's kind of right, the name of the game.
And I think,
and we can do that more easily if we say, hey, we might have 5 groups we work with all the time, rather than every single project you're just right, starting from square one. I can't imagine how difficult that would be. And even the administrative challenges associated. I mean, every lender, every closing company, every real estate company, they close things differently. They have different requirements for how you draw funds if you're doing some sort of construction or development. I mean, it's really, it's hard to kind of get to know new groups all the time. So right, we'd much rather do a lot of work with a good group of people that we've worked right, with.
In that same vein, and I hope I'm not overstepping on David's personal business, but he taught me that if lenders will always come to you and ask you for your financial statements, because they have auditing requirements and they have financial requirements that they have to adhere to. And if you can turn around and present to them a folder of all your financials 3 minutes after the email comes through in a well-documented, well-presented way, that gives them the confidence that you are doing things the right way. And so having your financials buttoned up with certainly your annuals, but then a quarterly kind of positioning of where your accounts are, and just making sure it looks really buttoned up and polished, is worth its weight in gold, and gives them that confidence that they need to continue lending with you. I know that a lot of our banking relationships that we do business with and we refer to and they refer back to us have that confidence, because they can send us a quick email and say, where are the rent rolls for this property as of 12/31 and 1/31 or whatever, and we can in 5 minutes blast it back to them. So they have confidence that their clients that they've lent to, working with us, can produce everything that they need to produce and are professionally managed and professionally handled. So kind of
we had, I mean, I think that's right on. We had a lender recently that they were doing they were doing a loan for a few different income producing rental single family homes, and they had, it wasn't quite on the term sheet, but verbally, I think they were much more comfortable with the concept that they knew who was building it. They knew who was managing it. They kind of knew it was in good hands. And I think that's a critical part of a bank feeling that their collateral or their borrower is kind of in good hands. So it's essential. I mean, I spend a lot of time and energy in my work focused on how we can ensure that we have the systems and processes, the people, the talent to do that. So.
And you're so diplomatic in your communication. Sometimes I just fire off a quick semi-nasty email. I'm like, get your SHIT together.
Yeah, I've been accused of writing text messages that look like little letters. So I'm certainly have my own way, for better or worse.
Let's talk about the build to rent space. I'd love to get into the Capital Homes Charney Property approach, or including tall grass. But how come there's been a strong trend in the build to rent movement? And who are the players nationally, kind of categorically, that are moving into the space?
Yeah, so I think it's probably best to go all the way back to really probably the Great Recession, 08, 09, and thinking about what was happening. First off, what caused that recession? Um, I think it would be fair to say that a substantial that the housing was at the epicenter of kind of the collapse in 08, 09. And there's a lot of reasons for that. But one of the events that occurred after that recession, or in the back half of the recession, was that uh, institutional equity, so large scale investors, started saying, "Hey, there is an investment opportunity to purchase single family homes with scale at a discount to what we believe their value is." And so you had groups like Invitation Homes, um, that maybe they have $18 billion or so of single family homes on their balance sheet. So I think the build for rent movement was really something that came after this idea that in real estate there's to my knowledge anyway always sort of been darling asset classes. So at one point it might have been self storage, or maybe it's medical office or manufactured mobile home housing. The build for rent single family space has been something that's been attractive before build for rent, even in just scattered site existing resale homes. So if you think about one of the things that institutional scale investors do is they look for areas where there is not yet consolidation of ownership, and they go and they consolidate and they create value that way. And so those folks are
Right.
creating value the same way our business is, the same way you are, Matt, the same way your customers are, your clients, where they're either generating cash flow, they're what they call HPA, home price appreciation, or principal reduction. And so prior to build for rent, there was this big movement to say single family homes can be managed with scale efficiently. And there was probably a pretty big technology shift there too, right? Because single family homes, scattered site, historically, the operating expenses and the ratios just weren't favorable. So in an era before computers and smartphones and GPS and all these different self-showing systems and whatever else there is now, it wasn't easy. So I'd say kind of step one was post recession, seeing the consolidation and kind of interest from large equity groups to invest in single family housing. I'd say the step two was this concept that maybe scattered site single family homes is kind of one investment concept to pursue, but that if you were a builder, let's change now from the investor lens to a
Yeah.
builder developer lens.
Yeah.
If you were a home builder or a developer and you were saying, could I create let's suppose you say, I live in a city, there's substantial demand for good quality housing. We want to build things that are nice that people want to live in. Sometimes that's for sale, sometimes it's for lease. And in the case of, in theory, we could go build homes in all of our neighborhoods that we sell homes in, and we could lease them. And we do a very small amount of that. But in general, that's not really been kind of our passion. What we have focused on is an area we call it dedicated rental communities. So they're neighborhoods, usually much smaller in scale than for sale neighborhoods. So it might be 30 homes, 60, 70 homes in a small neighborhood. And from site selection, acquisition, entitlements, the way we plat the lots, the size of the homes we build, the features of the homes, the amenities of the neighborhood, everything included in that is purpose built, with the idea of being that it's purpose built for rent. So the decisions made at each step of the way there might be kind of marginally different. And if you make 10, 20 different decisions that are significant, marginally different, then you get a project at the end that works and is really appealing for customers versus a project that doesn't work and might not pencil.
Right.
Within the build for rent world, there's really like two kind of ends of the spectrum. So one would be, let's call it horizontal multifamily, where the unit mix is very, very similar to a multifamily building. There's 1, 2, 3 bedroom units.
Yep.
They're all individual detached kind of bungalow units, but the square footages might range for a 1 bedroom, say around 700, 760 feet, up to a 3 bedroom that's maybe 1,200 feet.
Mm-hmm.
And those horizontal multifamily buildings are all they're all on one lot and one block. So they're not individually platted lots that could be bought and sold separately. It's one large piece of land. It's zoned for multifamily. It just happens to be built horizontally instead of vertically. The rents for those look a lot like apartment rents. The amenities look a lot like apartment amenities. So they'll have resort style pools and gyms, and they'll have walking trails, and usually they would have surface parking. Maybe you could pay for one garage space, similar to an apartment building. They generally have small backyards that are kind of private, but they're very small, and it almost like a porch or a small outdoor area in an apartment. So that's horizontal multifamily on one far end of the spectrum. And then the other end of the spectrum, which is really where we play, is individually platted lots. So take a neighborhood we're going to build in Owasso, and we've got wonderful support from our city, local city municipal body, the city planners, to do this. We're going to have a neighborhood that will be 62 homes, and the lots will be just a pinch smaller than the typical for sale lot. So instead of a 50-foot or 54-foot minimum, these will have a 46-foot minimum. So you get a few more lots in the neighborhood. You might build a slightly smaller home. In general, I think statistics or surveys show that most people, when they are renting, are not as willing to pay, and not as they just don't desire to have any extra space in the same way they might when they're buying a home. So whether that's a little bit more yard, whether it's 200 more feet on a house, in general, when you're renting, you tend to be a bit more pragmatic and say, well, this is something that's probably shorter term. If I go and buy a home, I might want, instead of 1,800 feet, 2,000 or 2,100. Right. So we're really making kind of all of our work it's really quite closely related to the work we do for sale, in our Capital Homes, our business where we sell homes to homeowners, and that's still the primary focus of what we do. But maybe each year we'll have somewhere between 30 homes, 60 homes, something like that would be in these dedicated rental communities.
So when you have dedicated rental communities, my fear and what I've seen in the past has been a general and kind of longer trending deterioration of the neighborhood, of the homes, etc. That could be because even though it's a dedicated rental community, they're individually platted homes, and those homes can change hands, and therefore you have different people taking care of their properties individually to different standards as investment owners. I mean, taking different approaches to their investments. How do you guys get around or how do you avoid the general deterioration of the rental community and ensure that it maintains a uniform look and continues to be beautifully maintained?
It's a great question. I mean, I think the number one thing, this is a commitment we've made to folks we work with in city planning. We talk with people extensively about, in dedicated rental communities, there'll be an HOA because these lots are individually platted. So in theory, they could be sold individually, even though they generally would not be. So the 62 lots would have one single owner. There would still be an HOA. And we, for all of our dedicated rental communities, have decided that we will take care of lawn care. So one of the biggest things if you think about kind of driving through or walking through a neighborhood in a near wherever one of us lives, you can always sort of tell, hey, this is a neighborhood where there's a certain sense of pride, or maybe there's the time and the resources to take care of a lawn, in some areas where that's not the case. So we, in all of our dedicated rental communities, we'll take care of lawn care, and that'll be included as a convenience fee. We just pass it through at our cost. Front and backyards. Wow. They'll have irrigation systems. They'll have the planting beds will be irrigated. Wow. And there'll be quarterly maintenance packages to take care of the shrubs and put mulch in. And I think the landscaping and ongoing lawn care and maintenance is really, really mission critical. Yeah. And then the other part that we think a lot about is the idea of replacement reserves, which I'm sure you work with your clients on all the time, which, the idea that somewhere in the ballpark of, every home, every year, we should put aside $300 in a replacement reserve account. And so let's say there's 60 homes in a neighborhood and $300 a year. That's about $18,000 each year that we're putting aside. So after 5 years, you've got a good chunk of change there. And say you need to replace the roof on every home, or you need to repaint the exterior of every home, or you want to do a little style refresh and you wait, 10 years. For us, the big concept that we are trying to drive home with how we set these projects up is to say that they will have the funds available and the resources there to kind of take care of them in perpetuity. Now, I think there's no doubt that when things trade hands, there can be sometimes things trade hands and they improve dramatically, and that's part of creating value in the world of real estate. And sometimes, if a neighborhood didn't see the same, if it didn't have the same sort of reinvestment or value add philosophy, it can deteriorate over time. But in general, the places, the locations that we're choosing and selecting for these projects are, I think we would consider them kind of 1A locations in growing, desirable suburbs with really, wonderful public schools and all those things. So I think, in a 20 to 40 year stretch, is it a concern? Probably just like it would be anywhere. But I think we're really taking every measure we can within the short term to say we don't want these to just look okay. We want them to look like this is a place I would love to live, or I'd recommend that my friend or family live. I mean, that's kind of our philosophy, is that we'd want to recommend it to people we know and care about.
Certainly, what you've said is that your intention is to keep them long term and not sell them. But we have also seen, not in A neighborhoods in A communities for sure, but we've seen both the amalgamation and the I guess what's the reverse? The disentangling of various property portfolios. So we had a client that amassed maybe 20 duplexes on a single street and went through bang, 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 fences, painting, roofs, trash containers, the whole deal, and made this fairly unattractive street change in a significant way. And when the rents had increased and the street looked much nicer, that client sold off pieces, and the pieces went to 6 duplexes to one investor, 2 duplexes to another, 1 or 2 to a third, a fourth, a fifth, and those have subsequently changed hands again. And then you see that all the work that was originally put together and the improvements that were made have started to deteriorate again, because one owner is not willing to repaint after 3 years and another is. And so it certainly can go both ways, but I appreciate all the thought that your team puts into maintaining both the good relations with the city, the promises, and then the follow through on executing to ensure that the communities stay beautiful long term. Yeah,
and I mean, I think the only other piece of the equation that's probably worth mentioning is, to your point in the example you just shared, that was a project, it sounds like, that had, the exit event was multiple different sellers, probably on different time frames, that each had different priorities. I think we imagine, at least, that if we were, at some point we would, most things are for sale eventually and at some price, so assuming that we would go ahead and sell it at some point, I think our belief is that it would be a group that is pretty well capitalized, probably had some scale behind them, and that we would package this as one specific project that really belongs together, so, but you're right on. And the best laid plans can change. And so it's certainly I suppose a risk or a possibility that things that are built kind of in as a package and developed with the idea of being purpose built for lease, and that they're all belong together, that they could at some point be subdivided. And I hope that it would be, I think that the homes would still be in such a location that they'd generally still be well cared for. But it's always a reality. You're right on.
What's interesting though is that so many of our clients that buy single family residential units love them because their exit options are far in excess of what an apartment complex would be. So single
Totally.
family
Yeah.
residential buyer buys property, holds on to it for 5 years, sells it. They can sell to a primary home user. They can sell to another investor. They can
For
sell to
sure.
an institutional group, et cetera. Whereas the opportunity here is fantastic. And the exit opportunity, however, is more limited unless you carve them up and package them smaller, which means you could probably get more money because you're selling them more retail than institutional. Somebody that's looking for
Yeah,
less of a
it
good deal
depends. I
potential.
mean, I think it depends on the prevailing market sentiment at the time that we're
Right.
thinking about selling, you know. So for example, I think we just came out of a 2-3 year period where we saw cap rates on build for rent projects. I mean, in hot markets like in the Sun Belt states or in parts of California. I mean, there were places where things were trading at like a 4 cap.
Wow.
So and the groups that are buying that at a 4 cap are the same groups that have access to the capital markets and debt structures that as average folks really don't necessarily
Yeah.
have access to. So
Yeah.
in some ways, I think you're right that the ability to subdivide and sell in individual home increments or small packages of homes might increase optionality. But I think there's also, I think, a pretty good body of evidence to suggest that the institutional folks involved in this space are still kind of in the early innings in terms of the overall macro consolidation.
Yeah.
Now, if
Yeah.
we went to sell right now, I have no idea what a cap rate would be on anything in the weird environment we're in. But it's certainly would be a sale price would not be what it was a year ago. You know,
Right.
the other thing that we really think about and focus on is, and this is a little bit of kind of in our DNA as a builder developer, but we're really trying to build things at a cost that is substantially less than their value today, even. So, we certainly hope that they continue to appreciate, but part of our goal is to have our total cost basis in a project be something that would kind of endure the test of time. It'd be hard to beat. It'd be hard to replace our location and hard to replace our costs, and very, very hard to replace our costs at that location.
Right.
If that makes sense.
Right.
Yeah.
Are you familiar with any ways that a small time investor, somebody that had 50 or 100 or $200,000 of cash, could get involved in a build to rent partnership or somehow procure part of the ownership of a build to rent community? Or are these only really
Yeah, that's a
for
good question.
larger institutions?
It's a good question. I mean, I don't know, a specific. There's so many different options available to investors today. Anything from REITs to to call it CrowdRise or FundRise, those sorts of platforms. I don't know. I don't know enough about any of those to necessarily recommend them. Then there's the whole world of kind of private placement offerings, things that are more of a friends and family capital raise, those sorts of things. So I think maybe learning about the market that a customer was interested in, understanding who's involved and who's playing in that market and how are they capitalizing their projects. That's probably
Right.
the best way. Um, what we've tended to focus on is trying to do projects that we have the bandwidth to do ourselves or with a very small number of folks outside of our company. But we're also really just focused on the Tulsa market. So, there's groups out there. I mean, there's a bunch of really incredible build for rent companies that like this is their entire
Yeah.
reason for being. They raise capital, they build staffs, they recruit people that have the skill sets required, and they go and do this in 20 different markets, and they look for the 20 fastest growing metros in the US. And I read an article once that said on a 1.5 mile stretch in Phoenix, there's something like 15 different build for rent projects. I mean,
Wow.
it's just so Tulsa's, that's not the kind of market we are. We're a pretty slow, steady market. We have some growth, but it's pretty good, modest growth, and we're not making. I would say that we are trying to create investment opportunities that align with our view of growth in our market. So, there may be places in Arizona, California, Florida, the Carolinas, wherever it may be, that are, 300-400 home neighborhoods at one time in one location. And that's just not how we see Tulsa. We see it as a city that grows, even the suburbs around it that might grow a touch faster, that the growth tends to be maybe 1%, 2 or 3%, something like that per year. So,
right. Ross, you're a student of both business and real estate. What are you studying right now? What podcasts do you like to listen to? What conferences have you attended? What little key takeaways do you think are valuable to share with some of our listeners?
good question. Gosh, I spent a lot of time on what I call real estate Twitter, and I never really put out a lot of information, but I read a ton. And there's some really, really talented people that are there's a spirit of community and kind of information sharing when it comes to real estate investing that I was just kind of floored to find. And I went deep into that for probably a year and a half or so. I don't do it anymore, but I would definitely recommend for someone early in their journey, like the amount of information available at your fingertips. If you look on Twitter, and I think the hashtag is Twitter, like RE Twitter, real estate
Cool.
Twitter is, and you can look that up. And there's people putting all sorts of deals together in all sorts of metros. There's a lot of people that raise capital. They're kind of in general, they're the GP, general partner in a GPLP structure. And there's one group that's really good at Class B industrial in Texas, and one group that's good at rural self-storage, one that does multifamily in LA. So, there's really something for everyone, and they each have sort of a different philosophy. So that was a really fun way to kind of think and learn and push my thinking. I've also read a good amount and listened to a lot of the podcasts from the real estate CPA firm. I think, if Bigger Pockets might be a resource for someone that's like very early in their career, trying to kind of get a lot of the essentials down. Maybe Bigger Pockets is 101 and 201, and I'd say the real estate CPA, I think the podcast is called Tax Smart Investor. And that might be more like 301, 401 level content, things like cost segregation studies, accelerated depreciation, bonus depreciation. So I'd say that's a really great resource as well. What else? I think those would be the big ones that I'd recommend. There was a great book I thought it was just fascinating, a book that was about Trammell Crow. And I can't remember the name of the book. I think it was like Trammell Crow, Master Builder or something like that. But it was, I loved the way that he built a really substantial real estate business, largely on trust and handshakes. And the spirit of that is so kind of aligned to how I wish the world would be, and how it can be in a lot of ways. But
that's Trammell Crow, Master Builder, the story of America's largest real estate empire.
Yeah. And I don't think it's even in publication, but you can find copies. And if any of your listeners want mine, I'm happy to send it.
Isn't his story kind of one of slow and methodical progress over many years? In other words, time in market, not time in the market. Or am I wrong on that?
Yeah. It was, he got started with one deal and then turned it into two, and then forged a relationship and said, okay, we'll do these 5. And just really, just a story of kind of building something over time, very relationship focused. And he also pioneered a whole bunch in the industrial real estate space. But I would say the concept of marts, like a the furniture mart, like making a place a destination where every business located, and all of a sudden you could get a whole bunch of great credit-worthy tenants, and you'd almost create a space where everybody in this industry would gather, and you kind of create a demand through doing that. So, just an interesting personality, and certainly an entertaining read.
I love it. Ross Heyman's the chief of staff for Capital Homes, a local production company, home building company, I should say, and of Charney Properties, a real estate investment and development company in Tulsa. He's focused on building a vertically integrated build-for-rent business opportunities for those businesses now, utilizing his expertise in land development, new home construction, and property management to provide excellent housing options for people in the Tulsa area. Ross, we appreciate you being on the pod.
Thanks, man. Always good to talk with you.
Take care.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.